Today is Saturday, 7th February 2026, and the silver market has just signaled something extraordinary, something that longtime analysts have quietly been waiting decades to see. And at Alex Carter Reports, we are here to break it down in a way that anyone can follow. Right now, silver trades at $76.89 per ounce, gold holds at $4,966.20, and Michael Oliver, a respected market analyst whose technical work correctly predicted the 1987 market crash, has just released a forecast so bold that even skeptical investors are stopping to pay attention. Oliver's minimum projection for silver is $500 per ounce, and he believes this could happen in just a few months, not years, which immediately makes it a headline-worthy event in the investment world. What separates Oliver from most analysts is his approach. He does not chase headlines, follow sentiment, or rely on conventional price charts. Instead, he studies the deep structure of the market, looking for patterns that unfold over years, quietly building the foundation for explosive moves that few notice until they are already underway. According to his latest analysis, silver has just completed what he describes as a rebirth following a recent price correction, meaning the market has rebuilt its structural strength and is now poised for what could be a historic advance. This is not your typical prediction based on guesswork or short-term price movements. Oliver's framework, known as momentum structural analysis, examines the underlying architecture of market movements and identifies transformations that develop silently over long periods, creating setups that can remain invisible to most investors until the right moment arrives. Between late January and early February, silver experienced a sharp correction, falling roughly 18% in a matter of days, which created panic among retail investors and a flurry of posts across social media claiming that the rally was over. Traditional analysts pointed to overbought conditions as evidence that silver had risen too quickly, but Oliver saw the exact opposite. He recognized a structural reset taking place, a necessary step for the market to build its foundation before the next major move. He compares this process to construction. Before you can add new floors to a building, you must strengthen the foundation, and that is exactly what happened with silver. The recent sell-off allowed long-term buyers to absorb selling pressure, effectively shoring up the market while the short-term traders panicked and exited positions. This rapid absorption of selling pressure demonstrates a fundamental change in the market's character. Short-term speculators reacted to volatility by selling, while industrial buyers and institutional investors saw an opportunity to accumulate, creating a base that is now stronger than ever. Silver's recovery was immediate and decisive. It did not drift sideways for months like in typical corrections. Instead, it snapped back with force, signaling that the underlying momentum of the market remained intact despite the sharp drop in price. According to Oliver, this type of behavior is often observed just before the most explosive stages of a bull market begin. Corrections of this nature do not weaken the market. They validate it, proving that the underlying demand is solid and that structural buyers are in control. This is why Oliver's forecast has drawn attention. When structural reinforcement is complete, the acceleration phase that follows often produces gains far larger than what casual observers expect. Oliver's approach to analyzing momentum is different from conventional methods. Most traders rely on trend lines, support and resistance levels, moving averages or relative strength indexes. These tools focus on current price movement but fail to capture the engine behind the trend, the real force that drives sustained bull markets. Oliver compares traditional analysis to watching a car's speedometer. You can see how fast the car is moving, but that tells you nothing about how much power the engine has or whether it is about to accelerate. Momentum structural analysis looks at the engine itself, measuring the strength and direction of the forces driving the market. His system examines multiple time frames simultaneously to detect momentum building quietly under the surface, sometimes for decades. This is the pattern he has observed before massive commodity rallies, such as in copper during the early 2000s, and in lead before an 18-month tripling of its price. Now, he sees the same pattern forming in silver, and the readings suggest a move larger than any of those historical precedents. According to Oliver, silver's momentum structure has broken through resistance levels that constrained it for over 40 years. This is not a minor technical breakout likely to reverse in weeks. This is a structural shift that unleashes pent-up pressure built over decades. When that happens, prices move quickly, often in violent bursts, catching many investors by surprise. Oliver calls this phenomenon lightning form repricing, a release of years of market pressure compressed into a short period. It is explosive, not orderly, and according to his current readings, we are still early in this acceleration phase. The gold to silver ratio provides additional context for why this could be significant. Currently, with gold at $4,966.20 and silver at $76.89, the ratio sits near 65 to 1, well above its long-term average of roughly 50 to 1. In historical bull markets, this ratio does not gradually revert to the mean, but often collapses dramatically as silver begins to outperform gold. sometimes falling to 30 to 1, 20 to 1, or even lower during mania phases. Because silver is a smaller market than gold, capital flowing into precious metals produces disproportionately larger price gains for silver. Its smaller market size and higher leverage make it extremely responsive to momentum shifts, especially when structural demand is strong. Oliver's analysis shows that silver has breached a critical resistance level relative to gold, a pattern that preceded explosive rallies in 1979, 1980, and 2010 to 2011. In both cases, silver surged dramatically in just months. The current structural base supporting silver is wider and stronger than it was during either of those historical periods, suggesting that the next rally could exceed previous gains. This forecast is not based on imagination. It is rooted in mathematics, momentum readings, historical patterns, and market structure analysis. If gold reaches $8,000 and the ratio compresses to 20 to 1, silver would trade around $400 per ounce. Even conservative scenarios point to gains well above current levels. Fundamentals support this outlook. Global silver consumption has exceeded production for over 5 years, creating a structural deficit of roughly 200 million ounces annually, a gap that continues to widen. Industrial demand is surging in solar panels, AI infrastructure, and electric vehicles, all sectors where silver is irreplaceable. Meanwhile, supply cannot respond quickly, as developing new mines takes years or even decades. This imbalance sets the stage for what Oliver calls rapid repricing, where prices adjust violently to match true market scarcity, rather than moving slowly over time. Recent market signals confirm this trend. COMEX delivery notices in January tripled compared to last year. New futures contracts were introduced to meet retail demand, and premiums for American silver eagles surged above 99.69, indicating growing physical demand. Governments are taking note as well. The U.S. Treasury has discussed securing silver supply chains, marking it as a strategic material, which adds another layer of significance beyond investment and industrial use. At Alex Carter Reports, we believe all these factors, technical momentum, historical patterns, supply deficits, and industrial demand, align to create a unique and powerful opportunity in the silver market. Right now, the silver market is showing signs that a major shift is underway, and at Alex Carter Reports, we want to explain exactly why this could be one of the most exciting opportunities in years. Michael Oliver's analysis indicates that silver has built a multi-year base, slowly coiling like a spring, storing energy quietly while many investors overlooked it. This base wasn't obvious on the surface, but the momentum readings tell a clear story. Silver is preparing to move, and the underlying force is stronger than it has been in decades. For years, silver traded in a defined range, consolidating and absorbing selling pressure without breaking down. This consolidation was not a sign of weakness, but a preparatory stage, allowing structural buyers to accumulate positions and set the stage for a dramatic breakout. Oliver identifies specific momentum trigger levels that signal when the market has shifted from quiet accumulation to active acceleration. These are not guesses or casual observations. They are rules-based signals derived from decades of studying commodities and precious metal cycles. As silver approaches these key levels, it is beginning to outperform gold in terms of momentum. While gold has traditionally led the way in the precious metals market, the internal strength of silver is now taking the lead, which is historically one of the strongest signals of a pending explosive rally. This shift from gold leadership to silver momentum is critical because it suggests that investors could see faster gains in silver than in gold. Silver's smaller market size amplifies these moves, and historical patterns show that once momentum favors silver, parabolic price action often follows. Industrial demand continues to strengthen this trend. Solar panels, electric vehicles, and advanced electronics all rely heavily on silver. The global push toward green energy and digital infrastructure creates a persistent demand that cannot be easily substituted or ignored, adding a structural tailwind to the market. Meanwhile, supply constraints remain severe. Mining new silver is a slow process, and existing operations are depleting high-quality ore. Recycling helps, but it cannot close the gap created by 200 million ounces of annual deficit, leaving the market primed for rapid price adjustments. Recent events illustrate the pressure building in the physical market. COMEX delivery notices surged threefold compared to last year. New futures contracts were introduced to handle demand, and U.S. mint releases sold out immediately with premiums rising sharply. These are not isolated events. They reflect a market that is tightening in real time. Confirming what Oliver's momentum indicators have been signaling, the internal structure is ready for an upward move. Government recognition of silver as a strategic resource adds another layer of significance. When governments and central authorities start acknowledging the scarcity and importance of material, it reinforces the long-term structural case for higher prices. Monetary conditions also favor precious metals. Major economies are struggling with high debt levels, forcing central banks to intervene and create currency, which effectively debases fiat money. In such an environment, tangible assets like gold and silver become safe havens. Oliver's analysis aligns perfectly with these fundamentals. The momentum base he identifies, combined with structural deficits, industrial demand, and global monetary conditions, creates a scenario where silver could experience rapid and historically significant price gains. Early indicators show that institutional investors, who have largely been on the sidelines, are likely to be drawn into the market once momentum triggers are confirmed. This influx of capital is what typically turns solid uptrends into explosive rallies. Investors must recognize, however, that markets will remain volatile. Corrections are a natural part of bull markets, often shaking out weak hands and creating opportunities for strong, patient investors to accumulate at favorable levels. The recent 18% correction is a perfect example. Those who panicked missed the quick recovery, while those who held positions or bought the dip benefited as silver snapped back to previous highs in just days. Michael Oliver's framework teaches that these corrections are necessary and healthy, allowing the market to strengthen before the next major leg upward begins. The acceleration phase that follows is where momentum compounds, creating outsized gains for those prepared to stay invested. This combination of technical structure, momentum readings, and supportive fundamentals makes silver uniquely positioned. While no investment is guaranteed, the probabilities, according to decades of historical patterns and Oliver's analysis, favor a powerful move. At Alex Carter Reports, we emphasize that this is not speculation. It's the convergence of multiple measurable factors: momentum structure, industrial demand, supply constraints, gold-silver dynamics, and macroeconomic conditions, all pointing in the same direction. For investors seeking to understand what could be next in the precious metals market, silver is showing the early signs of a breakout that, if sustained, could redefine expectations and offer exceptional opportunities. Watching how silver behaves relative to gold, paying attention to momentum triggers, and understanding the structural fundamentals will be crucial for anyone looking to navigate this market intelligently. The next leg of the move, according to Oliver, could attract substantial capital quickly, amplifying gains and driving prices far beyond current levels. At Alex Carter Reports, our focus is on presenting this information in a clear, actionable way so that investors can grasp the full picture, not just the headline numbers, and understand why silver may be entering one of the most compelling periods in decades. Silver's relationship with gold is one of the most powerful signals for investors right now, and understanding this dynamic helps explain why Michael Oliver's analysis is so compelling. The gold to silver ratio is a simple, yet incredibly telling measure. It shows how many ounces of silver are required to purchase 1 ounce of gold, and historically, it averages around 50 to 1. At present, with gold near $4,160.20 and silver at $76.89, the ratio is roughly 65 to 1, meaning silver is historically undervalued compared to gold. During major bull markets in precious metals, this ratio often compresses dramatically as silver begins to outperform gold, sometimes dropping to 30 to 1, 20 to 1, or even lower in mania phases. Because silver is a smaller market than gold, capital flowing into precious metals has a much bigger impact on silver prices, which is why these ratio compressions are often accompanied by explosive price gains. Oliver's analysis shows that the current ratio has breached a key resistance level, a pattern that preceded the massive rallies in 1979-1980, and again in 2010-2011. When silver surged far beyond expectations in short periods of time. What sets this moment apart is that the base supporting silver today is wider and stronger than during those historical events. This wider base suggests the potential for an even larger move because the market has had more time to build momentum before breaking out. The mathematics behind this scenario is straightforward. If gold reaches $8,000 and the ratio compresses to 20 bars to 1, silver could trade near $400 per ounce. Even more conservative assumptions, like gold reaching $6,000 with a ratio of 30 to 1, still places silver at around $200 per ounce. Oliver's minimum target of $500 per ounce implies either an even higher gold price, a more extreme ratio compression, or both occurring simultaneously. These targets are not speculative guesses. They are calculated outcomes based on momentum readings, historical precedents, and structural market analysis. History proves that such moves are possible, and Oliver's data suggests the conditions exist today to support them. Beyond technical factors, fundamentals are equally compelling. For more than 5 consecutive years, global silver consumption has exceeded production, creating a structural deficit of roughly 200 million ounces annually. This gap is widening rather than closing, and it is being driven by 2 major factors: exploding industrial demand and the slow, inflexible nature of silver supply. Industrial demand is rising rapidly in sectors where silver cannot be replaced. Solar panels, AI infrastructure, and electric vehicles all require significant amounts of silver. China, which dominates global solar production, consumes enormous quantities, And the expansion of data centers and AI applications only accelerates this demand further. As the world shifts toward renewable energy and electrification, silver's role in the industrial economy grows steadily, creating persistent structural demand that does not disappear in recessions. Supply, however, cannot keep up. Mining new silver deposits takes years, sometimes over a decade, involving discovery, permitting, construction, and financing. Past low prices discourage large-scale investments in new mining projects, and existing operations are depleting high-grade ore. Even recycling, while helpful, cannot bridge a 200 million ounce annual deficit, leaving the market fundamentally tight. This imbalance sets the stage for what Oliver describes as lightning form repricing, where markets ignore deficits for long periods and then adjust rapidly and violently. Unlike gradual price appreciation, this type of adjustment can create explosive, compressed gains over a short time frame as years of suppressed supply finally meet rising demand. Recent market events confirm these conditions. COMEX delivery notices in January were 3 times higher than the same month last year, indicating intense demand for physical metal. A new 100-ounce silver futures contract was introduced to accommodate record retail interest, signaling unprecedented buying activity from smaller investors. In China, silver prices briefly approached $100 per ounce, reflecting significant regional tightness and premium pricing. In the United States, the Mint delayed releases of the 2026 American Silver Eagle coins, and when they became available, they sold out immediately, with retail premiums climbing over $20 above spot price, highlighting physical scarcity. Government recognition further underscores silver's importance. The U.S. Treasury convened meetings to secure critical mineral supply chains, including silver, elevating it to the status of a strategic material with national security implications. These developments are concrete evidence that supply constraints are real and intensifying. All of these factors, the technical momentum base, gold-silver ratio compression, structural supply deficits, surging industrial demand, and governmental acknowledgement, combine to create a unique opportunity for investors. Oliver's framework shows that when all of these conditions converge, markets are positioned for rapid and powerful moves. This setup also creates extraordinary potential in junior mining companies. While physical silver and gold provide direct exposure, junior miners can offer amplified returns because their profits are leveraged to the underlying commodity price. A mining company producing silver at a cost of $20 per ounce earns $57 per ounce at today's price of $77. But if silver rises to $300 per ounce, profit jumps to $280 per ounce. Historically, stock prices of junior miners can move 3 to 5 times the underlying profit expansion. During mania phases, multiples can increase even further, creating life-changing opportunities for early investors. Previous examples include the uranium boom in the early 2000s, where commodity prices rose 7-fold, and the best-positioned junior mining stocks rose 50-fold or more. Similarly, lithium prices surged 13 times in 2022, with leading miners delivering returns exceeding 100 times their base valuations. Oliver emphasizes that selecting the right mining companies is critical. Investors must focus on unhedged producers in politically stable jurisdictions, such as Canada, the United States, and Australia, with competent management, strong balance sheets, and quality assets in regions with expansion potential. These are high-risk, high-reward investments suitable for a small, aggressive portion of a portfolio, but the potential returns are enormous if markets follow the expected trajectory. While opportunity is massive, risk remains. This market will be volatile, and investors must accept corrections as part of the natural bull market cycle. Legendary resource investor Rick Rule has highlighted that historic bull markets, such as gold in the 1970s, experience corrections of up to 50%, even as the overall trend surged from $35 to $850 over several years. Corrections shake out weak hands, create accumulation opportunities, and reset market sentiment before the next leg up. The recent 18% drop in silver, followed by a swift recovery, illustrates this perfectly, rewarding patient investors and punishing those who panic. Michael Oliver's analysis shows that silver has weathered these storms, completing a long-term basing process and emerging with a reinforced structure ready for the next major upward leg. Recent action, including the quick recovery and consolidation near key momentum levels, signals that the market is behaving exactly as expected before a breakout. The psychology of the market also favors those who recognize opportunity when others are fearful. For years, silver has been dismissed as poor man's gold and underperformed many other assets, which created negative sentiment, a classic indicator that a market may be poised for a significant turn. Now, with momentum indicators aligning, industrial demand surging, structural deficits in place, and governments acknowledging silver's strategic importance, the conditions for a historic move are all present. Those paying attention today may be positioned for one of the most compelling investment stories of the coming years. The next stage of silver's journey, as Michael Oliver outlines, is all about the acceleration phase, where momentum fully takes over and prices begin to move in a rapid, almost unstoppable fashion. At Alex Carter Reports, we want to make clear that this is where the real opportunity lies, but it's also where volatility can feel extreme, and understanding the dynamics is crucial. Momentum triggers are the key signals that indicate this phase is underway. Unlike conventional indicators that look at price charts or trend lines, these triggers measure the underlying energy in the market. When certain thresholds are crossed, it signals that structural buyers, industrial users, long-term investors, and institutions are no longer just accumulating quietly, but actively driving prices higher. Silver is already showing signs of this shift. Its momentum readings have moved past levels that historically marked the start of explosive rallies. These same patterns appeared before the 1979-1980 surge, and again in the 2010-2011 bull market. The difference now is that the structural foundation is even stronger, meaning the market could handle a much larger influx of capital without collapsing. This acceleration phase tends to attract a flood of attention. Institutional investors who have been waiting for confirmation will begin entering positions in larger sizes, adding fuel to the rally. The psychology here is self-reinforcing. As momentum builds, more participants join, which drives prices even higher, and the cycle repeats. At the same time, physical supply constraints continue to tighten. Mining production cannot quickly meet rising demand, and industrial users cannot easily substitute silver in critical applications. This combination of strong momentum and limited supply creates conditions for rapid price appreciation that can outpace nearly all traditional asset classes. Junior mining companies represent a particularly leveraged opportunity during this phase. These firms directly benefit from rising silver prices, and their profits can increase exponentially compared to the metal itself. Stocks of well-managed, unhedged miners in stable regions can see multifold gains in relatively short periods if silver continues its upward trajectory. Historical examples of this leverage are striking. During the uranium boom of the early 2000s, uranium prices increased sevenfold, and the best-positioned junior miners soared 50-fold. In the lithium boom of 2022, lithium prices rose 13 times, and leading miners delivered returns exceeding 100 times their initial valuations. The mathematics behind junior miners amplifies gains because their operational costs are fixed, while revenue rises directly with the commodity price. However, selectivity is critical. Not every miner will benefit equally. Companies with hedged production, weak balance sheets, political risk, or poor management may fail to capture the upside, even in a bull market. Oliver emphasizes focusing on high-quality operators with strong fundamentals in stable jurisdictions. Even with these opportunities, volatility remains a defining feature. Historic bull markets in gold and silver experience dramatic swings, sometimes losing 25% to 50% in short periods, only to surge far higher afterward. Investors must be prepared emotionally and financially to endure these corrections, as they are part of the natural cycle that strengthens the market. For example, during the 1970s gold bull market, prices eventually rose from $35 to $850, but in the middle of the advance, a nearly 50% correction occurred. Those who panicked missed enormous gains, while those who held or added positions during dips were rewarded with extraordinary returns. The same principle applies to silver today. Corrections shake out weak hands, reset sentiment, and prepare the market for the next leg up. The recent 18% pullback and rapid recovery illustrate this cycle perfectly, showing that the market is behaving as expected before a major breakout. The momentum structural approach allows investors to watch for confirmation rather than speculate blindly. Once silver crosses key levels and maintains momentum, the acceleration phase is likely underway, and the market's internal dynamics shift in favor of strong upward moves. At the same time, macroeconomic factors amplify the case for silver. Major governments face unsustainable debt levels, and central banks are intervening with currency creation, effectively debasing fiat money. In such an environment, tangible assets like silver and gold attract global capital, increasing demand and accelerating upward momentum. Industrial and technological demand continues to grow, particularly in renewable energy, electric vehicles, and AI infrastructure, reinforcing the market's long-term upward trend. Silver's dual role as both a monetary and industrial metal makes it uniquely positioned to benefit from these converging forces. Oliver's analysis indicates that we may be entering a rare moment where technical momentum, fundamental supply-demand imbalance, and macroeconomic pressures all align. For investors who can tolerate volatility and understand the long-term thesis, this setup represents a potentially life-changing opportunity. Understanding these dynamics is not about chasing quick profits. It is about positioning intelligently for a market that has been quietly building momentum for years and is now ready to release it in a powerful, fast-moving cycle. Timing, patience, and discipline are critical. At Alex Carter Reports, we stress that this is a story unfolding in real time. Momentum triggers, supply deficits, industrial demand, and macroeconomic conditions all suggest that silver is poised for a major advance. By paying attention to these factors, investors can navigate the market with greater confidence and potentially participate in one of the most significant precious metals rallies in decades. This is why Michael Oliver's outlook is so important. It combines decades of historical insight, rigorous momentum analysis, and real-world fundamentals to create a roadmap for understanding how silver may move in the coming months. The probability of a rapid, substantial advance is high, but so is the need for careful planning, patience, and awareness of risk. Silver's recent performance, its relative momentum versus gold, the tightening of physical supply, and the acceleration of industrial demand together create a compelling narrative. It is a moment where history, mathematics, and market structure converge, offering an opportunity that could redefine expectations for the precious metals sector. For investors watching closely, the key is to observe momentum signals, evaluate supply-demand fundamentals, and to remain disciplined during corrections. Early recognition of these dynamics can allow participants to position themselves advantageously before the market enters its most explosive phase. At Alex Carter Reports, our mission is to help you see beyond the headlines, understand the forces at work, and grasp the full scope of this emerging opportunity. Silver is no longer just a speculative asset. It is showing signs of entering a structural bull market, one that could deliver extraordinary returns for those who recognize the momentum and act with discipline. Now, as we bring everything together, it is important to look at the full picture of silver, its current setup, and why Alex Carter Reports believes this could be one of the most significant opportunities in recent history. Michael Oliver's analysis, grounded in decades of experience, shows that silver has completed a long-term correction and a multi-year basing process. The market has absorbed volatility, structural buyers have accumulated positions, and momentum indicators now suggest the acceleration phase is starting. This is the stage where prices can move rapidly, and early investors often see the greatest gains. The gold to silver ratio reinforces this thesis. Currently at around 65-1, the ratio shows that silver is historically undervalued relative to gold. When past bull markets entered their most explosive phases, this ratio collapsed dramatically, and silver outperformed gold, sometimes by multiples in very short time frames. The current structural base is stronger than in previous cycles, suggesting the potential for even more dramatic moves. Industrial demand continues to build. Silver is essential in solar panels, electric vehicles, AI infrastructure, and countless electronics. These are not temporary trends. They represent structural demand that will persist for years, creating a floor for prices. On the supply side, mining cannot adjust quickly. Discovering, developing, and bringing new mines online takes a decade or more, and existing operations are already depleting their high-quality ore. The resulting deficit, roughly 200 million ounces per year, creates a market imbalance that cannot be ignored. When combined with technical momentum, this deficit sets the stage for rapid repricing, as the market adjusts to match real-world scarcity. This is what Oliver refers to as lightning form repricing, where years of suppressed pressure are released over a compressed period. Recent market events confirm these pressures. COMEX delivery notices in January tripled from last year. A new 100-ounce futures contract was introduced to meet surging retail demand, and physical silver in the U.S. Mint sold out immediately, with premiums above $99.69 per coin. In China, silver prices briefly touched $100 per ounce, highlighting regional supply tightness. Even government actions, such as ministerial meetings to secure critical mineral supply chains, reinforce the strategic importance of silver. Junior mining companies represent a particularly leveraged way to participate in this move. Firms producing silver at low cost can see profits multiply dramatically as prices rise. And historically, their stock prices often increase 3 to 5 times, or more, relative to profit gains. In past commodity booms like uranium in the 2000s and lithium in 2022, leading junior miners delivered extraordinary returns, sometimes exceeding 100-fold. Selectivity is critical when investing in miners. Unhedged producers in stable jurisdictions with strong management and balance sheets offer the best potential for outsized returns. Companies with hedges, weak governance, or political risks may fail to capture gains, even in a strong market. Oliver emphasizes disciplined selection as the key to maximizing potential in this environment. Volatility must be expected. Corrections are a natural part of bull markets and can reach 25% to 50% in short periods. These moves are not setbacks, but opportunities for strong investors to accumulate more positions at favorable prices. The recent 18% correction in silver, followed by a rapid recovery, perfectly demonstrates this cycle, rewarding patience and discipline. Oliver's momentum structural analysis gives investors a roadmap. It identifies key levels where a shift from accumulation to acceleration occurs. helping market participants understand when the market's character changes and when large-scale rallies are likely. This is not about predicting exact prices, but about recognizing structural shifts and positioning accordingly. Macro conditions also amplify the silver thesis. High government debt and central bank interventions, including currency creation, effectively debase fiat money. Investors worldwide are seeking tangible assets outside of debt-based financial systems, and silver, with both monetary and industrial uses, becomes increasingly attractive. Central banks themselves have been accumulating gold at record levels for years, highlighting the long-term shift toward precious metals. The combination of technical momentum, structural deficits, industrial demand, leveraged exposure through miners, and supportive macro conditions creates an alignment rarely seen in markets. For investors who understand the risks and maintain discipline, this could be one of the most extraordinary investment cycles in decades. The key takeaways are clear. Silver has built a multi-year base, is beginning to outperform gold in momentum, and has a structural foundation stronger than in previous bull market periods. The industrial and monetary backdrop supports continued upward pressure, while junior mining companies provide the potential for leveraged gains. Corrections will occur, but they are part of the cycle and offer strategic buying opportunities. At Alex Carter Reports, we believe that recognizing these dynamics now allows investors to position intelligently. Observing momentum triggers, monitoring gold-silver ratios, tracking industrial demand, and understanding supply constraints all contribute to a strategic approach. The evidence suggests that silver is entering a period of rapid price acceleration, one that could deliver life-changing returns for disciplined investors who act with foresight. While no investment is without risk, the convergence of momentum, fundamentals, and macro conditions creates a scenario where probabilities favor a strong upward move. Those who recognize this moment remain patient through volatility, and positioned strategically are the ones most likely to benefit as silver begins its next major leg upward. In conclusion, the current market setup, as explained by Michael Oliver and analyzed here on Alex Carter Reports, represents a rare alignment of technical, fundamental, and macro factors. Silver has completed its structural preparation, momentum is building, industrial demand is accelerating, supply remains constrained, and macroeconomic pressures favor tangible assets. For investors paying attention, the coming months could present one of the most remarkable opportunities in the precious metals market in decades. By understanding the full picture, observing momentum triggers, and strategically positioning for this structural bull market, investors may have the chance to participate in a historic move in silver, potentially redefining expectations and delivering extraordinary returns.